Hi everyone, welcome back to Corporate Decoder. Today we're diving into Virginia National Bankshares Corporation's latest 10-K filing, their annual report. This is going to be interesting because we're going to see whether this community bank really is the pillar of financial stability it claims to be, or if there's trouble brewing beneath the surface. Let's see what the numbers tell us. This Form 10-K is their annual report filed with the SEC for the year ending December 31, 2024. It covers everything about their business performance and any potential risks. Consider it an X-ray of the company's financial health. First off, this is an annual report covering the fiscal year that ended on December 31, 2024. A key detail to note is that Virginia National Bankshares is a smaller reporting company, meaning they have less stringent reporting requirements than larger corporations. Keep this in mind as we analyze the data. Virginia National Bankshares Corporation, or VNB, is a bank holding company. Their main business is Virginia National Bank, which offers your typical banking services, checking accounts, loans, and trust services. Think of them as a community bank deeply rooted in the local economies around Charlottesville, Winchester, and Richmond. The bank actively solicits such accounts from individuals, businesses, and charitable organizations within its trade areas. They are a full-service institution. They also have some smaller financial ownership in insurance and title companies. It's a dog-eat-dog world out there. The company faces strong competition from bigger banks, credit unions, and even fintech companies. These competitors often have deeper pockets and offer more services, like larger branch networks. They are looking to stand out by offering a personal and customized financial services. Looking at their employees, VNB had 146 full-time equivalent employees at the end of 2024. It is worth noting that the company considers their relationship with employees to be good. As a bank, VNB is heavily regulated. They have to maintain certain capital levels and need to stay in compliance, or else the ASIC could come down hard. They are following what's known as the Basel III final rules, international standards designed to make banks more stable. One regulation is that they keep a certain level of capital, 7% in common equity, 8.5% in something called Tier 1 capital, and 10.5% in total capital to account for risk. It is worth mentioning that the bank's deposits are insured by the FDIC, so customers have some protection in case something goes wrong. Also worth mentioning is the prompt corrective action. A bank has to maintain certain capital ratios to be considered well capitalized and avoid regulatory restrictions. Cybersecurity is very important for financial institutions and is considered a risk. There are regulations that they have to notify their primary federal regulator of any significant computer security incident as soon as possible, and no later than 36 hours after the banking organization determines that a cybersecurity incident has occurred. Now, let's talk about risk. It wouldn't be a bank review if we didn't. The company's credit standards and its ongoing credit assessment processes might not protect it from significant credit losses. They are managing a lot of credit risk. The company has something called ACL, or Allowance for Credit Losses. The ACL is their estimate of potential loan losses, and there is a risk that this ACL may be insufficient. They adopted this new accounting standard called CECL, which means they have to predict expected credit losses over the lifetime of all loans. If they materially increase the level of ACL for any reason, such increase could adversely affect the company's business, financial condition, and results of operations. External factors like inflation, fluctuations in interest rates, pandemics, and market conditions can all affect their profitability, as well as consumers' and businesses' abilities to repay their loans. Interest rates, the company's earnings are affected by interest rates, and they may not be able to minimize interest rate risk. There are risks to operations. They also talk about reputational risk, legal and compliance risk, and the risk of fraud or theft by employers or outsiders. They are also concerned about the broader trend of people not using banks. That's called disintermediation. They are not a shell company. Their common stock trades on the Nasdaq Capital Market under the symbol VABK. Now that we've covered the basics, let's dive into the financials. Remember, VNB is a smaller reporting company, so there might be some missing data compared to larger firms. Before we get too deep in here, let's go over some terms that will be used. Diving into results of operations, this section is where we see if the bank made money and how. So net income for the year ended December 31, 2024 was 17.8 MSAL 11.99% decrease compared to the previous year. This decrease was the result of a $2.6 million decrease in non-interest income, offset by a $330 of non-interest income, offset by a $397 on 1,000 decrease in non-interest income, offset by a $397 and a dollars for DL. Dollars in non-interest income, offset by a $397 offset by a 390 decrease compared to the previous year. This decrease was the result of a $2.6 million interest income and a $1.5 million decrease in non-interest income, offset by a $397 million interest income and a $1.5 million decrease in non-interest expense. Their Tier 1 CET1 total capital to risk-weighted assets and leverage ratios of the company were all exceeding the minimum requirements. The bank received a satisfactory credit rating in its most recent examination. This is a measure of if they are serving the credit needs of the communities. Digging into how the company has been performing, they do have a share repurchase plan that was approved on June 28, 2023, which authorizes repurchasing up to 5% of outstanding common stock. There were no shares repurchased during the 3 months ending December 31, 2024, which means management thought there were better uses for the funds. Unfortunately, there are no quantitative and qualitative disclosures about market risk in the filing. That's too bad. All right, time for some raw numbers. This is what you all came here for. There are a ton of important definitions in this list. Be sure to check it out. That's a wrap on the report. It gives us some interesting, if limited, insights into Virginia National Bankshares. The ratio of net income to average total assets and average shareholders' equity and certain other ratios. Their return on average assets is 1.06% and return on average equity was 10.78%. A lower ROA and ROA than the previous year means they weren't as efficient in using their assets to generate profit. The efficiency ratio FTE was 62 was 62 was 62 was 62 was 60 was 62 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 was 62.0% compared to 58 to 462 ratio FTE. Was 62.0% compared to 58-30% the year prior, so it's increasing, which is not good. Net interest income, or the income they get from loans minus what they pay on deposits, was down. The Tier 1 CET1 total capital to risk-weighted assets and leverage ratios of the company were 17.94%. 17.94%, 18.94 advanced, 18.777 and 11.68% respectively as of December 31. I'll event to be well capitalized. As market interest rates rise, the value of the company's investment securities generally decreases. Higher interest rates reduce the demand for loans and increase the attractiveness of alternative investment and savings products, like US Treasury securities and money market funds, which can make it difficult to attract and retain deposits. They must also comply with AML laws. The HRCPA contained provisions expanding the number of regulated institutions eligible to use streamlined call report forms. The company, through its financial subsidiary Fauquier Bank Services, Inc., has equity ownership interests in Bankers Insurance LLC and Bankers Title Shenandoah LLC. The company's loan portfolio totaled $1.2 billion as of December 31, 2024, or 76.4% of total assets. Loan balances increased $143.43 million, increased $141.2023 then from the balance of $1.1 billion as of December 31, 2023. The ACL as a percentage of total loans was 0.68% at December 31, 2024 compared to 0.77% at December 31, 2023, so their estimate is lower than last year, which could mean trouble later on. The decrease is primarily the result of the impact of declining expected loss rates on most of the pools of loans within the CECL segmentation. The company's non-interest income took a hit, going down $1.5 million from 2023 to 2024. That can be caused by a number of different things. They have also created a Finance Career and AMP Leadership Academy. This shows that the company is looking forward to the future of the economy and is contributing to growing future generations. It has also allowed them to take promising students from the academy and have them employed by VNB. The company owns B-BOLI policies on each executive officer and certain other senior officers of the company. This is bank-owned life insurance which can be used for employee expenses. One final noteworthy event, the General Counsel and a named executive officer will no longer be an executive officer and General Counsel of a company, though will remain with the company as Senior Legal Counsel until December 31, 2025, which is her planned retirement date. There were no unresolved staff comments, which is good. Alright, so that was the filing. The numbers are in. And while they're still profitable, VNB is facing some headwinds. A slight drop in net income, a more competitive market, and the ever-present risk of defaults all paint a picture that's less rosy than management might like you to believe. However, it's not all doom and gloom. The bank is still well capitalized and they seem to have sound risk management strategies, but one should keep a close eye on that ACL. Virginia National Bankshares seems to be a pretty normal community bank, facing increased pressures like a changing market, increased competition and high interest rates. Their long-term success will depend on how effectively they manage these challenges. While they claim to be a pillar of their community, they are only a small bank in the big sea of financials. They have all the same problems that other banks do as well. All in all, a good report. Thanks for watching. If you enjoyed this video, please like, comment and subscribe for more corporate deep dives. See you next time on Corporate Decoder.